Hello and welcome, everyone. For those of you joining us today, we just ask that you put where your name and where you're zooming in from in the chat. And I will turn it over to Elizabeth Miller to get us started.
Thank you, Celeste. Well, good afternoon. It is just afternoon. My name is Elizabeth Miller. I'm the Vice President of Development and Communications at the Alaska Community Foundation, and we are happy to have you with us today to learn about smart giving strategies. We have almost 100 people registered for this session from all over Alaska at the invitation of our 12 affiliate community foundations, some of the nonprofit organizations who have funds at ACF, and of course, ACF invited many of our constituents. Welcome, welcome, welcome. Yes, I see folks are adding into the chat as Celeste had asked. Just tell us where you're coming in from. It's fun to see how far and wide we are today. So we offer this session as a community service because it aligns with Alaska Community Foundation's role in making giving easy and effective. So we are happy to have you here, happy to have our presenter here. Before I turn this over to Celeste to introduce our presenter, I do want to let you know that today we will be using the question and answer, or the Q&A feature for questions and answers. So if you don't see that at the bottom of your screen yet, you might have to press on the three dots that are maybe to the far right and click on that, and the Q&A feature should appear for you. We ask that you don't put the questions in the chat box. What we will be monitoring for questions will be the question and answers feature. And Celeste and I will answer any questions that we can during the presentation and then take care of those. And then what will be left will be those that Meghan will address towards the end of our session together. As Celeste let you know in the early chat, this session is being recorded. And we will post it on the ACF website so that you can review it later at your leisure if you wish, and you can certainly share it with others that you think might be interested. And with that, I will turn it over to Celeste, who is the Development Director here at ACF, and she's going to provide some basic information about Alaska Community Foundation and introduce our presenter. Celeste, take it away.
Thank you so much, Elizabeth, for that lovely introduction. Yes, hello, everyone. I see some familiar names on the screen. And for those who don't know me, my name is Celeste. Like Elizabeth said, I work here at the Alaska Community Foundation. And so I wanted to talk to you a little bit about why we're here today. And what is the Alaska Community Foundation, for those of you who don't know? So we have been around for over 30 years. We were established in 1995, and the Alaska Community Foundation is a nonprofit that cultivates, celebrates, and sustains all forms of philanthropy to strengthen Alaska's communities now and forever. We manage over $280 million in charitable funds, and those we will talk a little bit about in just a moment. But from donor-advised funds to scholarship funds to nonprofit agency funds. And together with our 12 affiliates, we grant out between $10 to $20 million annually to nonprofit organizations. We also administer the state of Alaska's Pick, Click, Give program, which helps give out donations from your PFD to over 600 nonprofits across the state. So what is a community foundation? So like I mentioned, we are a 501c3, and community foundations were established over 100 years ago when banks held charitable trusts from people who had passed, and they were making philanthropic decisions in their communities. But the banks couldn't kind of handle that administrative work, that philanthropic work. And so thus the first community foundations were formed to make charitable giving decisions to help impact communities or causes. There are over 900 community foundations across the United States. And at a very high level, community foundations play three different roles in their communities. One is that they are a platform for philanthropy. So community foundations work to help individuals, nonprofits, and businesses help give back to their communities. So for Alaska Community Foundation, we help folks give back to the state that has been so good to them and that they love dearly. The second role of a community foundation is that of a grant maker. So like I mentioned, we give out between 10 to $20 million a year in charitable grants to nonprofits and in scholarship awards. So community foundations can help build that local capacity by raising those charitable dollars that are then granted to those nonprofits in their communities. And the third is that of a community leader, so stepping up when Alaska needs us. Most recently, with the Western Alaska Disaster Relief Fund, we helped raise over $8 million in charitable relief efforts for communities affected by ex-Typhoon Halong back in October of 2025. There are many other examples where we've stepped up as a community leader by hosting community conversations around topics and issues that are near and dear to people's hearts, including childcare and food security. But we have a special platform that we enact whenever there's a need, that we can raise charitable dollars and deploy those easily to our communities when they're needed. And I mentioned how we're statewide is through our affiliate program. So we have 12 affiliates that cover the entire state of Alaska, from the Golden Heart Community Foundation up in Fairbanks to the newly established Chugiak-Heel River Community Foundation near to Anchorage. But we have many, many community foundations in the Southeast. I know there are a couple of folks who are joining us from the library in Chilkat Valley. So hello to our Chilkat Valley Community Foundation folks. But we have 12 across the state who do local fundraising and local grant making in their communities. And there are many ways to give to your favorite charities. You can give to them directly, or the Alaska Community Foundation can help you. We can help you with current assets, cash, appreciated stock. Meghan is going to talk about all the types of different charitable tax benefits you might get from giving in a variety of different ways. But the Alaska Community Foundation can be a resource to you. Should you choose to work with us to open up a fund that can help benefit either a student through a scholarship fund or many charities through a donor advised fund. We can also help you with bequests via your will or estate plans through legacy giving or planned giving. So we're always happy to be a resource for you and help you if you so choose. You can also name a charity or a variety of charities in your retirement account through the beneficiary designation forms. But you can always pick up the phone, call us. We have an office full of people who are here and ready to help you. So, and as I mentioned, the Alaska Community Foundation can help you leave your legacy. So one of the ways, Meghan is going to touch on it, that you can give back to the state that has been so good to you is by leaving a bequest to a charity in your will or estate plans. Alaska Community Foundation has resources and expertise to help you guide you in this area. So definitely feel free to reach out. Always happy to chat with you about those resources. And without further ado, it's my pleasure to introduce Meghan Muñoz, who's going to lead us in this conversation today. So Meghan is a CPA, a CFP, and a CDFA, and is a partner, chief financial officer, and senior financial advisor at Alaska Wealth Advisors. She specializes in helping individuals and families navigate complex financial decisions with a focus on tax-efficient planning, charitable giving strategies, and multi-generational wealth stewardship. Meghan's background is in both public accounting and wealth management and allows her to bring a strategic, tax-aware perspective to the financial and philanthropic goals of the families she advises. She's a frequent speaker on advanced planning topics and has presented for organizations including the Schwab Advisor Network and the ERISA Forum and the Anchorage Estate Planning Council. Meghan also serves on the Alaska Society of CPAs board and its Financial Literacy Committee. We are so pleased to have her here with us today, this afternoon, and share her expertise. I am going to stop sharing my screen so that Meghan can share her screen and lead us in this conversation today. Welcome, Meghan.
Thank you. Thank you, Celeste, for the lovely introduction. I am going to share my screen here first and foremost. It says I need screen sharing ability.
There, that should have done it.
I think that is perfect. Okay. Screen presentation up on the screen, Celeste?
Yes, perfect.
Great. Okay, thank you. Thank you again for the lovely introduction. I'm delighted to have the opportunity to speak today about charitable giving. It's a topic that I'm passionate about, and I get to speak with clients often about the individuals and families that I'm privileged to help support in their financial goals. I think it's fair to say that most, if not all folks, donate to charity first and foremost because they believe in supporting important causes and aim to expand the reach and impact of charitable organizations by way of their efforts. And I think it's also fair to say that individuals and families appreciate the tax benefits that might come alongside making those donations. And so I think if it's true that being intentional and strategic and thoughtful about the ways that we give can both help us save in taxes and potentially result in a larger overall donation, then we should certainly spend time exploring those strategies. So, excuse me. Agenda today, there have been a number of tax law changes recently, some of which influence the strategies that we'll talk about today. So we'll spend just a couple of minutes covering those changes, and the bulk of the discussion will center around the primary tax advantage gifting vehicles. Before we cover new ground, one of the questions that came over in advance was to revisit what the existing limitations are on deductible charitable donations. So just as a refresher, for cash donations to a public charity, they are limited to 60% of your adjusted gross income. That number drops to 30% if it's to a non-public charity. If you are giving assets, appreciated securities, generally the limitation is 30% of your adjusted gross income to a public charity, 20% to a non-public charity. So on to the changes. With the One Big Beautiful Bill Act, or OBBBA, or I saw OB3 as a shortcut for the mouthful, that was signed into law on July 4th of last year, came a host of tax law changes, including some that touch the charitable world. So for individuals, one of those changes was a welcome introduction that allows people who are not currently receiving a benefit for their charitable donations to do so. And this is for individuals who do not itemize deductions on their tax return. So in 2017, the Tax Cuts and Jobs Act, if you recall, basically doubled the standard deduction. And so it increased the hurdle that people had to achieve with itemized deductions and dropped the number of people that itemize. What that means is that there are a lot of people donating to charity that don't receive a tax benefit currently. And so this new above the line deduction is effective 2026. So for the tax return that you'll file by April 15th of next year, and allows you to take a deduction up to $1,000 if you're filing single or $2,000 if you're filing jointly. So I use myself as an example. My husband and I give monthly and by way of our PFD through Pick Click Give to a particular charity that we really care about, and ad hoc throughout the year as causes arise that we feel inclined to support. We separately pay interest on a mortgage, we have property taxes, but the collective total of the charitable contributions, the property taxes, and the interest do not exceed $32,200, which is the 2026 standard deduction. So while giving to charity warms our hearts, we aren't currently receiving a tax benefit. Starting in 2026, we'll get up to $2,000 of a deduction on our tax return. There are particular rules with this new deduction. It has to be a cash contribution to an eligible 501c3 organization. Documentation must be retained. That's pretty typical, not just for this particular donation. And the deduction cannot be, or excuse me, the donation cannot be made to a donor advised fund or to certain private funds. So Next major change is a less welcome change, which is that there is a new floor to deductible charitable donations. The hurdle, there's now a hurdle rate that you have to exceed before your contributions are deductible, and that's 0.5% of your adjusted gross income. So said differently, a portion of your donation is no longer deductible. To put that in perspective, in terms of actual numbers, if your adjusted gross income is $200,000, 0.5% of that is 1,000. That's your hurdle rate. If you donate 5,000, only 4,000 will be deductible. Along with the new floor, the OB3 Act continued its renovations and instituted a ceiling that primarily impacts high-income individuals, those that are in the 37% top marginal tax bracket. So itemized deductions are now capped at, or the deductions are now capped at 35%, meaning the value of your donation is reduced from 37 cents to 35 cents on the dollar. I'm going to attempt to use my pen on the screen to illustrate what this looks like because there's a couple calculations that are involved. So pardon my handwriting. It's like when you're signing with the pen at the grocery store. So let me just put this in this setup. So in this example, Jack and Jill are a married couple filing jointly. They have adjusted gross income of $1 million in 2026. They're in the top 37% tax bracket, and they plan to make a $100,000 donation to Jill's mother, to American Cancer Society in honor of Jill's mother. So first, we have to take the 1 million and multiply it by 0.5%, and that's $5,000. So the original 100,000 donation is now 95. So the floor has been applied. Then we have to take the 95,000 and reduce that by the new 35% deduction cap. I realize this looks like a toddler is drawing it. And that brings us to 89,865. So our original donation amount of 100,000 is now 89,865, which means the reduction to the original amount is 10,135. And if we apply the 37% tax rate to that, that equals 3,750 in lost tax savings. This is something we have to live with. There's a couple ways to get around it with strategies that are available to people of a certain age, but otherwise there might have been planning that you did at the end of 2025 to accelerate deductions so that they would not be subject to the floor or to the cap, but helpful to know how this works in practice. Okay, very quick overview on new tax rules that are applicable to corporations. This is for C corporations. The total amount of contributions, the charitable deductions are still limited to 10% of taxable income, but the new change is that the total amount of contributions must be greater than 1% of the company's taxable income for the year. So that begins in 2026. Okay, so to the exciting part of the conversation, since we got taxes out of the way. Well, we didn't really get taxes out of the way because we're going to talk about how we can save them. But Elizabeth actually shared a great article with me that put the primary giving strategies in terms that we can relate to, especially with the recent Winter Olympics, with putting our Olympic hats on in terms of bronze, silver, and gold medals. All are excellent accomplishments, all are deserving of recognition, but there are some that shine more than others, which I'll save the gold medal for last. The first two that I'll talk about, in my mind, don't have as large of a gap in terms of favorability as QCDs, which is the third that we'll talk about. But we'll start by talking about donor-advised funds, which again, Alaska Community Foundation helps support individuals in setting those up. What are donor advised funds? They are powerful charitable giving accounts that allow donors to make sizable tax contributions in a single tax year without having to allocate those funds to charity at the same time. The benefit of that is you get an immediate tax deduction, but you can also invest that money, the donor advised fund, in the market, let it grow tax-free, increase the total amount that you're giving, and still meet your annual planned giving amounts, but recommend grants over time. There are a couple of things to keep in mind, or rules, so to speak, to keep in mind with donor advised funds. Number one, the deductions are subject to the adjusted gross income limitations that we talked about before. Contributions to a donor advised fund are irrevocable. So once made, they're technically the legal property of the sponsoring organization, though you can recommend grants over time. They have to go to public charities, so they can't be used for pledges or private non-operating foundations. A term that you'll hear a lot with donor advised funds or DAFs is bunching. And that means combining multiple years worth of contributions into a single year. I'll start with a simple example and then come back to where we can get a little bit more advanced in using donor advised fund contributions to our benefit. But this example is related to an individual who's filing single in 2026. If this person gives $10,000 a year typically and doesn't have any other deductions that would allow them to itemize, they are never exceeding the $16,100 hurdle of standard deduction despite their giving. So they're getting the same standard deduction that anybody under the same circumstances is getting, even if they don't give to charity. If instead they have the ability to lump that all together and contribute $30,000 in year one, they've now exceeded the standard deduction hurdle by $13,900 and received that in tax benefit. And then they can invest that money if they so choose and let the account grow. And they can also recommend grants to charity along their normal schedule. They can still give $10,000 in year 1, 2, and 3, but they received a tax deduction for having lumped the contributions into a single year. Same applies here if you're married filing jointly, and now the hurdle's $32,200. If you're over 65, you have an additional standard deduction. If you qualify for the temporary senior bonus deduction, that's even higher. So the hurdle gets higher and higher that you have to exceed before you're realizing the tax benefit of your charitable donation. So bunching can be really powerful in that way. In my work and my background as a CPA, I really enjoy the puzzling and tax strategizing, and DAF contributions are an amazing tool that can be used, for example, to offset a higher income year or to pair against using another advanced financial strategy that might pertain to your situation, like a Roth conversion, for example. I'll take an example of a client who had a year where she received a raise unexpectedly and larger bonuses. And so it was a year where that income was pushing her up into a higher tax bracket than she expected. She is charitably inclined. She regularly gives $15,000 to $20,000 a year. And so we worked with her to establish a donor advised fund. She contributed $100,000 in 1 year and got the tax deduction subject to her AGI limitations, and then invested the money and has let it grow, which has compounded the impact and the reach that it has. And she's also continued to fulfill the annual $15,000 to $20,000 planned giving that she does. And this is something that bunching doesn't have to just be done once, right? It can be done over a strategic, series of years where you bunch into 1 year, you give over 3, then you make another big contribution, so you get the tax benefit, and then you give over the next 3. So it can be a series that's established, but again, is really powerful in helping offset income or pair against other strategies. Let's see, I think that is what I wanted to cover on donor advised funds for now. The next charitable giving strategy or method for gifting vehicle that exists is gifting appreciated stocks to charity. So if you have securities in your investment accounts that have appreciated significantly and are subject to a large unrealized capital gain, you can transfer a portion of that stock, or all of it if you wish, to charity from your brokerage account in kind, meaning it stays intact. You don't have to liquidate it and send the cash to charity. You typically would receive a tax deduction based on fair market value, subject to that 30% AGI limitation if it's made to a public charity. Again, one of the main reasons this is powerful is the charity does not pay capital gains tax at liquidation. So this means you can potentially make a much larger gift at full fair market value than you would if you first sold the security, paid tax, and contributed the remainder in taxes, net of taxes, excuse me. So as a more simplified example, if you have $50,000 of Apple stock and 40,000 of that is at a gain, if you first sell the stock, then you'll pay tax on the $40,000 gain and then contribute a lesser amount net of taxes to charity. If you take $50,000 of your Apple stock and give it directly to charity, you get a deduction on your tax return. You don't pay tax on the gain. The charity can immediately liquidate it and pay no tax on the capital gains if they need it for a particular cause. So that's very powerful. These strategies can be paired together. So I have an example of a client who, married couple, they have 30% of their net worth very concentrated in tech stock that they started buying a long time ago. And they have other diversified assets that we help them manage, but they have a large concentration. They also are very charitably inclined and wish to establish a donor advised fund. It's one of the strategies we're using to help reduce that concentration and the risk that they have in their portfolio that presents to their retirement planning. So the strategy here was actually to take a portion of the appreciated stock and give that to the donor advised fund. And so they were able to receive a deduction on their tax return and help reduce the amount of their portfolio that's allocated to this particular tech stock. We've also been able to use that deduction to offset different financial goals. So liquidity events like needing to raise cash to build their dream retirement home, that comes with capital gains. A donor advised fund contribution can help offset some of that. So lots of complex and cool strategies that can be paired alongside your charitable giving desires. So based on the questions sent in advance and just my knowledge of qualified charitable distributions, I understand there's a significant interest in discussing QCDs, which is great because that's the gold medal giving standard for those who are eligible. Qualified charitable distributions, or QCDs, are unfortunately not available to everyone. So there's an age hurdle here, which is why we spent some time talking about other ways that you can give, even if you're not QCD or RMD eligible age. But QCDs allow individuals who are 70 and a half or older to donate up to $111,000 per year in 2026 to one or more qualified charities directly from their pre-tax or taxable IRA account. This can be used to directly offset part or all of a required minimum distribution, or RMD. RMDs are the point at which the IRS requires that you start taking money out of your previously tax deferred account. This presents problems for some people. They don't need the RMD for their cash flows, so it's money they have to pay taxes on that they don't need to spend. It could push them up into a higher tax bracket than they would otherwise be in. And so if you have charitable intent, QCDs, offsetting your RMDs, is a phenomenal strategy that has even more benefits that we'll talk about. Although QCDs are primarily used to pair against RMDs, you don't have to be RMD age to make a QCD. So QCDs, you're eligible when you're 70 and a half, which used to be the same as your RMD age. Now RMDs are required that you turn 73, and in a few years, that age will increase to 75. But you can still make QCDs at age 70 and a half. It's important to know you have to be actually 70 and a half, not the year you turn 70 and a half, but you have to actually have reached that milestone in order to do this. Why you would make a QCD before your RMD age, it doesn't hit your income. It also could help reduce your IRA balance that's subject to RMDs in the future. We'll focus on the RMD offset portion just because that's primarily where it's used, but important to know that that's available. So let's see. I want to skip ahead to illustrate an example of where this can be powerful. So in this example, an individual's RMD is 100,000. If they draw that directly out of the IRA, pay taxes on it, and then make a $100,000 contribution to charity after the fact, your adjusted gross income has increased by 100,000. If your adjusted gross income in total now is, for example, 140,000 because you've got a pension or Social Security, the 60% AGI limitation limits you to 84,000, but now you have to apply the 0.5% AGI floor, so only 83,300 is allowed in the same year deduction. You roll forward 16,000 to a future year and 700 is lost forever. If instead you take that entire $100,000 and make it payable directly to charities by way of QCDs, impact on your AGI is 0. You realize the $100,000 benefit in the same year, and QCDs can be used as a tool to help you avoid surcharges that are based on your adjusted gross income. So if you're Medicare age, there's a 2-year look back, and they're looking back 2 years at your adjusted gross income. And if you exceed certain thresholds, your Medicare premiums are more expensive, and that is recalculated every year. If you take the RMD out directly and that 100,000, in this case, say you're filing single, now you're above the first IRMA bracket, your Medicare expenses are higher. If instead that goes directly to charity, that never appears on your adjusted gross income, so it's not subject to those increases. It may also help avoid other deduction phase outs like eligibility for the temporary bonus senior tax deduction, the state and local income tax deduction that's subject to income phase outs, the amount of your Social Security that's taxable. And again, it gives us flexibility to be able to potentially implement other tax strategies like Roth conversions, or we may need to realize some capital gains in a particular year to send you money for your retirement or to build your house or to gift to grandkids, right? So incredibly powerful tools. They're advantageous for people who do not itemize because you get to realize the tax benefit on top of your standard deduction. And it's beneficial for people who do itemize and have enough separate from charitable contributions to take itemized deductions, because there's no AGI floor of 0.5% that's applied, and there's no 35% deduction cap. So this is a really, really powerful tool to consider. A couple of requirements to go over. So the maximum, let's go back. The maximum QCD limit is 111,000 in 2026. That has increased over the years and is indexed for inflation, so will continue to increase over time. And that's per individual. Has to go directly to the charity, so it cannot touch your bank account. It has to be made payable directly to the charity to count as a QCD. QCDs cannot be made directly from employer retirement plans like 401ks, 403bs, or 457s. It has to come from an IRA. So it's one thing that may require extra scrutiny as you're getting closer to RMD age. If you're planning on implementing a sizable amount of QCDs, and again, it doesn't have to be, it's not all or nothing, it can be anywhere in between, but you may want to look at consolidating accounts into an IRA, because a lot of times employer retirement plans mandate that you take your RMD first before you roll money out. And so if you're in a year where you desire to do QCDs, but now all of a sudden you're 73 this year, you'll actually have to take your required minimum distribution from your employer plan and can't offset that after the fact. Another really important rule is called the first dollars out rule. So what this means is that you can't retroactively apply a QCD to your RMD if it's already been met. So if in January, your RMD is 50,000, January, you take 50,000 out to your bank account, and then later in the year, November, you say, I want to make a $10,000 QCD, but I want to reduce the amount that I took as my RMD. That doesn't work. Now it's a total of 60,000 distributed, 50,000 is taxable. Instead, in January, if you say I want 10,000 allocated to charity and 40,000 drawn payable to me, now that 10,000 is offset part of your RMD and only 40,000 of the 50 is taxable. QCDs cannot be made payable to donor advised funds, to private foundations or supporting organizations, so it must be made payable to eligible 501c3 organizations. Okay, let's see. So all the strategies we've discussed so far are primarily about giving during your lifetime. That's a lot of the work that I do and help with. We don't have a ton of, well, we do still have some time left, but we aren't going to get into any level of complexity about legacy planning beyond your lifetime. That's something where ACF, Alaska Community Foundation, can provide a lot of support as well. But as Celeste was mentioning earlier, we do want to talk about the power of using beneficiary designations on investment accounts to leave funds to charity. You can, of course, make specific bequests by way of your will or trust with your attorney. Remember, charities don't pay tax on legacy gifts, and there are added benefits to using beneficiary designations on retirement accounts or transfer on death designations on your taxable brokerage accounts listing the charities. That can add the benefit of an expedited estate administration process by bypassing probate, adding privacy to the estate planning process. But it is important that you discuss the titling of your non-retirement accounts and your overall estate plan with an attorney to make sure it's cohesive and matches, is aligned with your wishes and current regulations. If giving to charity is part of your estate planning, there can be more advantageous ways to structure things. So consider this example. If you have a large IRA, your beneficiaries are your two kids, 50-50. Everything else in your will is left 50-50 to your kids after $150,000 specific bequest to your favorite charity or list of charities. The IRA that you're leaving to the kids has to be paid out within 10 years following your year of death, subject to ordinary income taxes at their prevailing tax rate. There are, as with anything, a number of it depends or other things, like if you are a spouse or disabled, right? There's exceptions to this 10-year rule, but in general, for a named beneficiary on your IRA, they'll be subject to this 10-year payout. That was part of the Secure Act regulation changes a couple of years ago. Okay, back to the example. So if instead of designating the 150,000 by way of your will, you carved out 150,000 of your IRA and said, I want this part to go to charity, and you list beneficiaries, charitable beneficiaries, and the rest is available for your kids. There's no problem with that. Now there's 150,000 more in after-tax assets to go to your kids, and $150,000 less that is ever subject to income taxes because it's been left to charity. And this is something that we discuss with clients all the time. So there's a client that comes to mind who specifically requested $50,000 of her IRA to be designated for charity. So we actually carved out and opened a new IRA, moved $50,000 into that account, and she listed her favorite charities, causes that she, believes in, as the beneficiaries, and left the remainder with her kids as the beneficiaries. And so now that carve-out IRA will bypass probate and go directly to charity, and there's more in after-tax assets left for her kids. I'm going to pause there and open it up to questions. I know we've covered a lot of ground, and again, there's a lot of different avenues we could go that are custom to individual situations, but hopefully this provides a good overall summary of really effective and powerful tools that can be used to maximize your giving desires.
Megan, I want to hop on. Susan asked a question earlier about the rule about the above the line charitable deduction, $1,000, $2,000, and that donations to donor advised funds don't count on that. And she said, is that one's DAF or something like Network for Good or both? I wanted to clarify. It's any DAF, whether it is your own or somebody else's. However, Susan, Network for Good looks like a donor advised fund, but they're structured differently. So your specific question about Network for Good is they're not a DAF. So anyway, I just wanted to hop on and clarify that answer. And would you have anything to add to that, Megan?
No, thank you. I think that's just highlights the importance of it. When in doubt, ask the organization how they're structured if it's not clear, to make sure that it's an eligible donation.
And we have no other questions in the Q&A. So
I did see a question in the chat. And so Mary Forbes asks, is there an age requirement for donating appreciated stock?
There is not an age requirement associated with that. So you can do that whether you're in your early years or you're retired and at the end of your life. There's no age-based requirement. So really the only strategy that we've talked about that has an age attached to it is the qualified charitable distributions.
And Megan, though, do you want to speak briefly to you have to have owned that asset, the stock, for at least, is it a year before you can donate it? So personal age, but the age of the stock does come into play.
Yeah, thank you. Yeah. So to get the deduction held, must be held what's considered long-term, which is a year of owning assets. Thank you for clarifying that piece.
And we have another question, again from Mary. Megan, can you please clarify the 70.5 age requirement for QCD? And then speak a little bit about what you said about Medicare premiums. So yep. Medicare starts at 65 and then the QCD is 70.5.
Yep. So you cannot utilize the QCD strategy until you have reached age 70.5. Which again used to be the same as your required minimum distribution age and now has changed. But I could still, if I'm 70.5, I'm going to use the example of Schwab allows you to you can either request a check directly or you can get a checkbook that's attached to the IRA that you don't write checks to yourself, but you write them directly to the charity, so it qualifies as a QCD. I can still write a $5,000 donation to a charity at 70.5 and it doesn't touch my income. It's not offsetting an RMD because I'm not required to take any money out of my IRA, but it's still a way to fulfill my charitable intent that also can help reduce my IRA balance that is going to be subject to RMDs a couple years later. That's a little bit of a challenging one because if your account is invested in the market, it could grow to outpace the amount that you distribute. But if you're giving sizable charitable contributions, that's part of your giving plan, then again, that can lessen. This is where I could go down lots of rabbit holes, right? But if you had, as an individual, after-tax brokerage accounts and IRA money, it may be more favorable to be making your charitable contributions from your IRA so that your RMD is smaller in the future and we can take more from your taxable assets and keep your overall tax impact down. I'll back up to talk about the Medicare premiums, which is separate but sort of related. At age 65, assuming you're no longer working and are eligible for Medicare, you have to enroll in Medicare. Typically Part A, Part B, and then a lot of times Part D in a supplemental policy, depending on whether you have retiree health coverage through your job. There's a base level of premiums that apply to everyone, but then if your income is higher, they have different brackets. If your income exceeds a certain threshold, you have what's called an income-related monthly adjustment amount, or IRMA, which means you're paying a surcharge on your Medicare premiums. And that amount can go quite high. Unlike tax brackets where it's graduated, a portion of your income is taxed at the 10 and the 12 and the 22. The IRMA brackets are cliffs. So once your income has reached a certain threshold, you're now in that bracket for that year and your premiums are going to be higher. It's pretty unforgiving, but it's recalculated every year. So IRMA Medicare looks back 2 years and they look at your income from 2 years prior and they assess your premiums based on your income that year. Where QCDs and IRMA meet is that if you are now at RMD age and your required minimum distribution of $75,000 is going to subject you to Medicare premiums, you can use QCDs to reduce the taxable portion of the RMD, which may also mean you aren't subject to Medicare premiums. It can reduce the income that appears on your tax return, and then IRMA may not apply. So it's a tool to help manage your IRMA bracket.
Thank you so much, Megan. We've got a few other questions here in the Q&A section. Yes, thank you, Susan. Thank you for those who sent us questions in early. We'll go through those at the very end if we have time to get through some of these questions live here. But how does the floor apply to monthly giving? So the charitable giving floor. So each individual monthly amount, or is the aggregate to the same charity in the year? And then also, what AGI are we talking about, 2025 or 2026?
So the AGI will be for 2026, and it's not going to look at monthly amounts. It's going to be an aggregate. So if you are giving $100 a month and the total is $1,200 by the end of the year, for calculation purposes, it's just going to look at the entire amount. When it comes time to file your tax return and you say, okay, this is how much I gave, 0.5% of my AGI is going to reduce whatever in total you gave for the year.
And I can jump in and answer the next one. Mardell has asked, who sets up a DAF? Do I need a lawyer, or can a financial advisor do this? And is there a minimum amount of years that can be bunched? Mardell, you can work with a financial advisor. Many financial advising firms have the ability to set up donor advised funds. And that is also a role that the community foundation can play. You can set up a donor advised fund at the community foundation and support local philanthropy. And then, is there a minimum amount of years that can be bunched? No, I mean, you can put whatever you want into a donor advised fund. The bunching is a strategy on how to use that. And Megan, would you add anything to that?
Just to say exactly that, there's no minimum number of years. It's how much you wish to give that makes sense given your tax situation. So that's normally a bit of puzzling on your particular situation and what makes sense. And you can just observing the overall AGI limitation. So if the amount you put in a donor advised fund in cash exceeds 60% of your adjusted gross income, some of that is going to roll forward and not be deductible in the particular year. But the bunching, I don't remember if I said this earlier, the bunching doesn't have to just be done once. You can do it, bunch 3 years in 1 year and then give 3 times, your annual amount the next 3 years, and then bunch again and get the tax benefit, and then give over the next 3 years and then bunch again. So it can be used as an ongoing strategy.
And if you get a windfall in one of the interim years, you can give more to the donor advised fund. It's exactly. Really based on the assets that you have to give to charity.
Mm-hmm.
And there's another question here in the chat. Can donors contribute appreciated mutual fund shares? So let's say they don't own singular stocks, such as Apple, for example. So can the donors contribute appreciated mutual fund shares directly to charity to avoid taxes in the same way as the appreciated stock example?
Yes. Yep.
And I would just jump in and say, absolutely agree with Megan's answer. The answer is yes. And just be prepared. It sometimes takes a little bit longer than making a donation of stock. And so if you're trying to do that towards the end of the year, please give the charity a lot of time, because it's not as quick as donating stock.
Thank you. That's helpful.
Then I think we know the answer to this one, but can privately traded stock be gifted to charity?
That is yes.
And I would jump in there and say yes. And a lot of nonprofits are not, equipped to do that, but that's another role that community foundations can play in your charitable giving. Is we can handle more complex gifts, and privately traded stock is one of those.
Great questions. Thank you. Anything else in the chat?
Well, those were all the questions right now in the chat and also in the Q&A function. I'm going to go through some of the advanced questions to see if there's anything that we didn't cover already. But please, if you're still on this call, please, if you have a question, put it in the Q&A feature and we will answer that live. Okay, one question here that I think I'm going to ask. This is an advanced question. One person asked or stated that they have given their RMD as charitable gifts, so they've utilized that QCD every year, and that has worked perfectly. However, unfortunately, one member of this couple has passed. And theirs was the age that had that required RMD. And so the remaining spouse will not have the RMD for 3 more years. And so how does that change this person's charitable giving when their spouse who had the RMD is no longer with us? How does that change the remaining spouses, the living spouses, RMD, if at all?
So how does it change the RMD, or how does it change the
Maybe
tool
charitable giving,
give?
QCDs from the RMD. Yeah.
So presumably, if there's still a few more years before the living spouse hits RMD age, they may or may not be QCD age. If they are not, then that does change, obviously, the resources available. And so you would give according to the other strategies available, donating appreciated stock, contributing to a donor advised fund. You may have enough in itemized deductions to give cash and not have to use a more advanced vehicle. So it's still fine to donate cash if you have it, or donate in-kind donations if there's enough to exceed that threshold. If not, you'll have the above the line, the new above the line deduction. If the surviving spouse is QCD age, but not yet RMD age, the balance of the deceased spouse can be rolled over and treated as their own in their own IRA, so that there is not an RMD requirement, and they can do QCDs still if they're 70 and a half, which may be advantageous depending on their particular situation if future RMDs are going to be burdensome, or if it helps fulfill just annual planned giving. So I apologize if that was a little bit nuanced of an answer. It's a little bit of it depends on the stage that you're at and whether you're QCD age or not. But if 70 and a half QCDs can still be used, if not, some of the other methods we discussed are impactful.
Thank you, Megan. And I see there's another Q&A that Elizabeth answered in the Q&A section. And then there's one coming in from Chilkat Valley Community Foundation. So can you donate to a 501c6 organization in the same way as to a 501c3? And I see Elizabeth came off mute to maybe answer that question for us.
The answer is no. The 501c6 is not a charitable, it's not a tax deductible charitable organization. Whereas the 501c3s are the donations to them are considered tax deductible. Would you add to any of that, Megan?
No, I think that sums it up.
And then just for folks who maybe are not able to get to that Q&A feature, I'll just say the answer to Janice's question, which does the Alaska Community Foundation charge a fee for helping form a donor advised fund? And the answer is no, we do not charge a fee for setup. There is an annual fee of between 1.5 to 2% of the average fund balance, depending on if that fund is endowed or not endowed. And I'm still looking at those advanced questions. A lot of QCD questions that have already been answered, which is great. We've already talked about making QCDs before one is eligible for RMDs. Okay, here's another question though in the chat. It says, when you say it takes more time to donate appreciated mutual fund shares than appreciated stock, does that mean more time for the receiving charity to sell the mutual fund shares or more time for the donor to transfer the shares to the charity? And I would say really more time for the donor to transfer those shares to the charity. But Elizabeth, I'm not sure if you would answer any differently, or Megan.
It's the process, and I don't fully understand why it takes the extra time. But once you, as the donor, initiate that with the administrator of your mutual fund, um, there is a delay in getting that received by the nonprofit. And it could be a week, it could be a couple weeks or longer when we're talking about what the delay is. So if you're thinking about that towards the end of the year and it's something you want to complete for a certain tax year, just keep that in mind.
And I think that brings up a good point just in general with charitable giving, even with QCDs. November, December are typically high giving years. People are giving over the holidays. However, that presents a challenge with making sure that gifts are received in time to be able to receive the tax benefit associated with it. So in addition to processing time for donor advised fund contributions, QCDs issued right at the last minute, if they're not cashed by the charity at the end of the year, it doesn't count towards your required minimum distribution. And so we tell clients and recommend that they issue checks the earlier the better, and or tracking closely to make sure the charities have cashed the deposits. We monitor and make sure that clients' RMDs are fulfilled one way or another, but if you're attempting to get the tax benefit associated with it, leaving more time for processing, if it's going by mail, if the charity lumps checks together, you just want to make sure that it doesn't miss that deadline. Okay, sounds like we've maybe covered our questions here. Okay. Well, if you can believe it, that's just kind of scratches the surface of how things can be tailored and customized to your particular situation for optimizing your tax and charitable intent. So whether you're in your working years, as we've talked about, or if you're retired and drawing income, there are strategies available, and structured properly, these can achieve both tax savings and bigger charitable impact. That may mean that the trail is developed, that a domestic violence survivor has access to shelter, that a child has access to educational resources, that our arts community is vibrant and thriving. And me personally and our firm is long rooted in the community here. We really believe in supporting our community and are grateful that you're here learning how to do that more optimally. And though I can't see your faces, I thank you for being here today, and I'm available for any follow-up questions or discussion with my contact information up on the screen. And I am required by compliance to flash the fun light reading up onto the screen of our disclosures. And otherwise, as Celeste and Elizabeth mentioned, this has been recorded and will be available on the website for reviewing. And then again, please feel free to use me as a resource, and of course the Alaska Community Foundation to look at your particular situation.
Thank you so much, Megan, for your time and your expertise. We really appreciated having you here. And thank you for giving us just so much information, so much knowledge. And yes, we will share this recording out as well as Megan's contact information. And if you have any questions at all, feel free to reach out to the Alaska Community Foundation or to Megan at Alaska Wealth Advisors. Thank you all so much for joining us. I hope you have a lovely rest of your day, wherever you are in the world. Any final questions or comments, Elizabeth or Megan?
I would just thank all of our attendees for taking time over their lunch hour. Well, I saw somebody was from the East Coast, so it's almost her dinner hour. But I'm happy to have you here with us. And I see lots of comments in the chat feature that it was helpful. So bravo, bravo. Thank you.
Thank you all. Have a great day.
Bye,
Bye-bye.
everyone.
Bye.